Hello, everyone. Today on the final bar, my guest is Frank Cappelleri from Instinet, coming up to us from the New York area. We're going to talk about this market overall, which has been in distribution mode up until today. Today was really about accumulation. It was a nice bounce off of the previous swing lows with the S&P pushing higher almost 1%. So the question is this the rebound pushing higher and acceleration back to the upside, or is this the latest bounce in a series of bounces that we may encounter? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of technical analysis, the power of data visualization, the power of stock charts, focusing on the message of the markets themselves. You know, there's so much speculation, debate, discussion, anticipation about what different potential drivers would do to stock prices, what the market should do based on inflation concerns and Biden policy changes and geopolitical issues and the Fed and earnings and all these different things. Always worth remembering that the message embedded in price is arguably the most important thing to do. If you want to understand, in my opinion, if you want to understand what's going to happen or what's most likely to happen with stock prices, focus on stock price up until this moment. Focus on the message of the markets. The markets will tell you, the price will tell you when people are excited or nervous or euphoric or desperate or full of greed or full of fear and everything in between. So let's look at some of these charts together, focus on the message that the markets can provide us. We have a great guest today, Frank Cappelleri from Instinet, going to give us a good sort of long-term picture of what's happening with stocks here. And again, with no doubt, we're coming off of extremely high levels, and let's see what may be next. Tomorrow, we have Sam Stovall from CFR Research in New York. Next week, on Tuesday, the 27th, we have Todd Sohn from Strategas. And then on Wednesday, Joe Duarte, an options expert, joining us. Joe did a really good job with the Options 101 week. He had a tutorial. And if you missed that, go to our YouTube channel, go to StockCharts TV on demand, and you can check out his educational session. Really, really well done. Let's continue here with our market recap. So if you look at the two-day chart of the S&P, you can see the tale of two markets. Yesterday was what I call the distribution day. It was really the first half of the day where the selling really was occurring. The rest of the day was sort of stabilizing around those lower levels. Today, we pretty much accelerated to the upside. Didn't really look back, a bit of a pullback at times, but overall, it was a nice sort of slow and steady uptrend. So looking at the chart of the S&P, we've not regained the all-time highs, but boy, we got really close to making a new all-time closing high today as we pushed higher and higher going through the end of the day. So, again, the challenge with a day like this is, it's hard for me to look at something like today and say, that's the all clear thumbs up. I think things are great again, because I've seen plenty of the long-term concerns, plenty of the issues with overvaluations and overbought conditions and individual stocks that are breaking down. We're going to talk about later today. We have a segment called Compare and Contrast. We're going to look at two particular stocks which have come off of fairly elevated levels and have been struggling more recently. Which of those two make more sense? But I think the real tell is the fact that both of them are in a position of weakness. These are names that I would argue, if everything is good, those stocks should be doing better than they are. Small caps certainly feeling the love today, and you've seen a lot of relative weakness in small caps. The ratio of small versus large, if you look at the IWM versus the SPY, for example, has been in a pretty severe downtrend for the last month, right? Last 4 to 6 weeks, I would say overall went from outperforming to underperforming. Changed today, a nice bounce today with the small cap index up over 2%, mid caps up almost 1.7. That's compared to the S&P up about 0.9%. The VIX actually moving lower, pretty much expectedly down around 17.3. Very quickly on other asset classes, a lot of movement, a lot of fluctuation in the 10-year yield, but in the end didn't finish far from where it ended yesterday, around 156. The bond price TLT up about 0.2%. The dollar just a little bit weaker, but not a lot of fluctuation there. Gold and silver, certainly stronger parts of the commodity complex with the GLD up about 1%. Commodities overall a little weaker, and energy prices, oil prices down today. Cryptocurrencies mixed today, and you've had obviously a lot of volatility, I think, for life for things like Bitcoin, but certainly fluctuating a lot in the last 4 or 5 days. If you include the weekend on something like Bitcoin, Bitcoin down 2% from yesterday, around 55,300. But others, things like Ethereum and Litecoin, actually having a pretty decent day. So when we look at the chart of the S&P again, we're going to talk with Frank Cappelleri in a bit and look at a little bit more in depth at the S&P 500. But again, a day like today fits into pretty much anyone's perspective. If you're bullish and you're just looking for pullbacks, making higher lows, you could argue today is just a nice bounce after the most recent pullback, and the uptrend is just running on unabated. If you're bearish, you should feel just fine with a day like today, because after the last 2 days, after the distribution that we've seen, and parts of the market have been down pretty significantly. If you look at some of the individual stocks and the givebacks that they've had, it's totally reasonable you'd have a bounce after a couple week days like this. So this fits into pretty much everyone's perspective, I would say. So if you're bullish or bearish, you could come up with a reason why today makes a ton of sense. Again, that's why we don't look at individual days in a vacuum. We look at the trend. And, again, anything that I use in my toolkit is analyzing trend. This is our market trend model that we review every Friday. It's still bullish across the board. And again, this is based on weekly data. But even given today, this current incomplete week, it's sort of short-term, medium-term, long-term, all very bullish, right? We'll have to see if we get further distribution Thursday and Friday. I could see a scenario where the short-term model turns negative. That would be brought on by closing below the 5-week exponential moving average, not too far away. It's just a little bit below the low that we saw yesterday, but certainly could happen. But overall, it's worth noting that the long-term and medium-term are firmly in the bullish camp. The trend has been positive up until today. And again, coming off the last couple of days, we're still very, very close to all-time highs. So not a lot to be worried about there. Sector is kind of an interesting rotation. So you've had some of these cyclical sectors at the bottom, all rotating more to the positive side today. Materials, number one, followed by financials, energy, industrials, consumer discretionary, all those top 5 very close to one another, all with a decent update and all outperforming. On the downside, you only had one of the 11 sectors closing lower. That was utilities. And what's interesting with utilities on a relative basis, have actually emerged very nicely here. If you look at utilities and real estate, actually, the utilities sector has rotated, I would argue, from a stretch of underperformance to a stretch of outperformance, right? If you look at the end of February, it's where we're at right now. And again, as a technician, I'm always looking for potential patterns, and I can't help but notice these similarities from, sort of last year, April through November, and what I'm seeing now, last November through where we're at currently, sort of this, downtrend, and then a nice uptrend of about, 6 to 8 weeks. That's about where we're at with utilities. We're getting to the end of that. That's this leg here. September, October, November of last year, and then the similar up leg here. It's pretty silly to argue that this would obviously mirror the previous time that happened, but it's worth noting we're about at that similar sort of time frame where utilities outperformed. Utilities were in a nice little bounce higher. The question is, do you have more of a sustainable rally, right? Does the XLU move on to further highs? Does relative strength continue to emerge and break out of this pattern of a short-term stretch of outperformance after a longer-term period of underperformance? Again, overall, the sector is testing long-term highs, and it's certainly worth paying attention to. Looking back here, just to focus again on some of the patterns. So renewable energy equipment is a group that's been way at the bottom of the list for a while. These are things like Plug Power, which has been a challenging name for a while. All the solar stocks are in there. Enphase, those are names that are in there. And we've brought them up so many times looking at them just because of the rotation. So here's Plug Power. It's interesting. This had been the top ranked stock in the mid-cap scooter rankings for months and months and months. This is during this period when it was just accelerating to the upside. Look at the relative strength and how how much it's outperformed by. But look at how all of that changed really starting at the end of January. And this just turned over and has been rolling over pretty significantly, up about 7.5% today. It's giving you what's called a bullish engulfing pattern, right? A nice up day where day two engulfs the range of day one. You could call it a bullish outside day if you use bar charts. This is coming off of an oversold condition. So arguably, potentially at a nice bouncing point coming off of an oversold condition. The question, of course, is this a short-term bounce before the next leg lower? And overall, that's what I would be looking for. I'm not a big fan of buying the lows. I would much rather see a stock like this prove itself, make a higher low that shows me, that demonstrates that there is buying power and it's not just a one-day thing. Here's Enphase, which is another stock up about 5.5% here. You know, this is one that's actually been stable for a while, but still in a consolidation pattern. So the group overall did very well today. Again, my concern with some of those is this is coming off of fairly depressed levels. Other groups you can see in the top here, it's the ones we talked about yesterday and the day before that are still in a period of weakness. Things like airlines, gambling stocks, and others that have been sort of the reopening trade, recreational services. Those are things that have been struggling and bouncing good today. At the bottom of the list, it's a lot of utilities. And again, that's a sector that overall has done very well. But today, giving back some of those gains. Brewers as well. It's actually an interesting group. Some of the stocks making new swing highs are in that group. So interesting to see it struggling today a little bit. We need to take a quick commercial break. We'll be back with my guest, Frank Cappelleri. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close as we look at these markets together using the charts, using the message that the markets provide through price. As a reminder, we'll do another mailbag segment at the end of this week on Friday's show. We would love to answer one of your questions on the air. Anything that comes up in your own analytical process, things you see or read elsewhere, ask us whatever you want. We'll do our best to point you in the right direction. Our email is thefinalbar@stockcharts.com. On Twitter, we're there at FinalBarSCTV. Just tag us in a comment. Finally, on our YouTube channel, just put a comment right below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment. Also, as a reminder, the new StockCharts TV on demand is out, available for you. You can go to StockChartsTV.com, use your email, set up a free account, check out all of our great content from our hosts, our guests, and all the great ideas and market wisdom, market knowledge that we provide there. We're also on all the app stores, so check out StockCharts TV on demand. I want to welcome on my guest joining us again on the show, Frank Cappelleri. Frank's the technical analyst at Instinet, based in the New York area. Always brings a great long-term perspective, and people like Frank are listened to by a lot of money managers and institutions. So it's always a pleasure to have him on. Frank, welcome back to the show.
Thanks so much for having me, Dave. It's always a pleasure to be here.
So when I think of you, I think about always bringing a good long-term perspective, helping us put what's happening now, what's happening this week, relative to how we should try to make sense. We're just trying to put things in proper context. Walk us through what you're seeing with the S&P 500. You're starting with the daily chart of the S&P.
Right. So this is just a simple trading channel, but I think it does a very good job of capturing the ebb and flow of this now 13-month uptrend, because oftentimes, even in the best markets like this, buying a new all-time high doesn't give you immediate gratification. And we can see that oftentimes, even though we're up a good amount, it does have a tendency to get heated. And we see that when it does, overheated that is. And when that has happened, the red arrows show that we've had some sort of drawdowns, right? And right now, from March 25th until present, the biggest drawdown we've seen is 1.7%, which has really just occurred from Friday's high to yesterday's low. But the most important thing, my biggest takeaway, is that despite all that, we continue to have higher lows, right? And so just when the market looked like it was about to roll over a number of times, that's when demand came back with the biggest or the most aggressive way. And so I think this is the type of thing we need to watch for. So if we do have to pull back just a bit more, I still think that we'll see some support within this upper submarine channel.
The trend is in place until proven otherwise, right? Now, you're looking at a second chart as a measure of breadth. What is this showing?
So this is something to look out for, right? We know that just going back to the past years, in 2017 and 2019, when the market was extending higher, it was supported by a gradual improvement of new highs, right? And we see that new highs and a 10-day moving average of new highs. Now, things changed when things got a little bit too good, so to speak, right? And we saw that spike through the upper sloping channel both times, and that gave us an idea that things were extended, and it led to two really severe volatility events as we see there. Now, the reasons behind both of them are different. At the same time, we shouldn't ignore something like that if it happens again. Now, currently, we're still within this upper sloping channel. Again, new highs are expanding as the market increases. That's what we think. But if we see a cluster of new highs, say above 120, 140, whatever it is, all of a sudden, that again may give us an idea that we should expect a drawdown of more than we've seen at the very least.
Interesting. So two charts sort of illustrating we're sort of at the upper end, sort of that upper end of the channel and upper end based on the extreme breadth here. Now, chart 3 is actually showing a bit of history looking at volatility, right? When we have larger movements.
Right. And so this takes a slightly different view in the fact that this goes back to 1960. So plus and minus 1% moves on a rolling 12-month basis. And we see those spikes during the most pressured times of the market, right? The crash from internet bubble, the great financial crisis, and just recently. And this is the fifth highest one we've seen in history, right? And so what happens is, big moves during the downside, but also big moves as you come out of a big downturn. So what tends to happen after that, that number goes down, right? So look at 2017, we only had 1% moves all year. So the thought here is that if this number is actually peaked and coming lower, that means we can be supported by a longer uptrend, which has fewer amount of big moves, lower volatility and lower volume. So, right. So, we talked about the risks before. This is if things just extend higher, as sometimes happens after a big move from the bottom.
Very, very interesting chart. I've not seen that one before. Now we're sticking with this theme of looking at gains or volatility. Talk us through the last chart here.
Right. So all of this comes back to the much bigger picture, in the sense that we've now come and had 4 quarters in a row of at least 5% gains for only the 5th time since 1950. And for the first time since 1995, which the most important thing is that was the very beginning stages of an eventual 14-quarter advance, right? Historic time, of course, because you're talking about 1995 to 2000. But if you look through all these instances, you can go back and look at them on your own, is that all of these happened closer to the beginning of major uptrends than the top of one. So whatever happens next quarter or the quarter after that, I think we have to keep all of this in the context of what it's showing us.
It's a very interesting take, and I'm curious. We just have about 30 seconds, Frank. But I'm, given what we've seen so far this week, a couple of days which are certainly felt more distributive, and then the bounce which you're seeing today in the short term, when you're thinking more tactically and looking at a chart of the S&P 500, what would you be looking for to signal that this correction that everyone seems very anxious for or looking for? What would tell you that it's starting to play out? Is there something we haven't seen that would tell you, yes, this is the time when we need to start getting more tactically defensive?
I think the biggest thing is that we're so used to the rotation, especially small caps to large caps. And so if you think about the small cap, you just mentioned the IWM versus SPY, that has gotten the most depressed since September. And so just when that type of rotation you expect to see flip doesn't happen, that could tell us, right? Because right now those are showing topping patterns. If those play out, that means the large caps are rolling over, and it's getting even worse for the small cap space.
Frank, it's always a pleasure to have you on. Thanks again for coming on, sharing some charts with us. Stay safe, be well, and we'll talk to you again soon.
Thanks so much, Dave. Talk to you soon.
That's Frank Cappelleri. Frank's the technical analyst at Instinet, based in New York, and I love that. Just what a great walk through the process of looking at of some of these market dynamics. And this first chart, as he kept going through the other charts, my mind was stuck in some ways on this first chart. Just great way of illustrating, the trajectory that we've seen. And it reminds me, this V bottom reminds me just a lot of the V bottom that you had in 2009. We've talked about, in my opinion, this relationship of 2009 and 2010, and what I think 2020 and 2021 could be like, and thinking of 2021 as another version of a 2010, which was choppy, more volatile, and a lot of swings in both ways. this kind of illustrates how we could have a decent pullback, an S&P down to 3,900, and still be within this nice trajectory of making higher highs and higher lows within that long-term time frame. So great chart, and one that I will certainly keep in mind as we go forward. Let's continue on our next segment called Compare and Contrast. What we love to do is sort of mimic what you may do at an investment shop, at a money manager. It's just something we would do when I worked at a large buy-side firm, was comparing multiple stocks. Right, we have a couple stocks that look really good from a fundamental perspective. For example, how do they line up? And we do stock A versus stock B. We'd even, with a team of people, do the bull or bear argument and vote on which one, and we'd see what came out on top and debate the strengths and weaknesses. And often we would force people to take the bull and bear side of these different charts and see what we could tease out. Today, what I wanted to do is look at two particular names, Zoom and TripAdvisor. These are two stocks that have fallen on harder times. If you look at the last, it depends on which stock we're looking at. Zoom's been in a downtrend for about 6 months now. TripAdvisor a little more like 6 weeks, but both of them coming off of really aggressive highs, extreme overbought conditions, and after having really good runs, and now both have struggled. And the question is, which of them presents a better technical opportunity right about now? The way we're doing this, by the way, is using the gallery view function. If you go to the top of StockCharts where it says Sharp Chart, has a little arrow, switch to gallery view, and then just enter, if you enter one ticker, it's going to give you 4 charts using that one ticker. But if you do one ticker, comma, the second ticker, you can actually line them up. And it's a great way to A/B 2 different stocks, sectors, ETFs, industry groups, whatever you're looking at. It's a great way to compare and contrast 2 of them. My charts may look a little bit different, by the way, and you'll see a little message in gray here at the top of your page. If you click on Learn How, it'll show you how you can actually customize the charts that are used in this visualization. I've tweaked mine a bit to be more in line with what I want to when we do. We're going to start with the intraday view. I'm not going to pay a ton of attention to the intraday view because I'm thinking more longer term on these, but it's worth noting in the last couple of days, both of these have seen a similar pattern of distribution and a nice bounce higher today with Zoom up pretty good amount, closing up about 0.3%. TripAdvisor with a much better reversal in the short term, up about 6% today from yesterday's close, but both rebounding nicely off of relatively weak levels. So let's start our real discussion here looking at the last year for both of these. So we have Zoom on the left, we have TripAdvisor on the right, and again, different businesses, of course, but both sort of similar names in terms of or similar patterns in terms of nice rallies that have started to roll over. Zoom has actually been in a downtrend for the last 6 months, actually topped out in October here. You can see the downtrend of lower highs and lower lows that have happened with Zoom. On the right, we have TripAdvisor, which is really only not too far off of all-time highs, peaked out around 65. It's down around 50 after the nice bounce today, but was nearing around 45. So, about 25 for 20% below its all-time highs there. So both of them have come off of higher levels, but I'm certainly drawn to the differences in terms of the extended downtrend that we've seen from Zoom. So looking at this last 6 months or so, you can see that Zoom's been in a clear pattern of lower highs and lower lows. And I'll tell you right off, when that's the pattern that I'm seeing in Zoom, and it's similar to the pattern that you've seen in other names that have had sort of downtrends, you don't want to see, you would want to see some sign of accumulation. The question I'm seeing right now is, have we had enough of a bounce to indicate buyers have come in and set a floor of sorts around 300 to 320, and this is rounding higher? I don't know if it's too early to declare that, but I don't know if I could clearly say, Zoom has reversed higher. At this point, it's more of in a sideways range, sort of in this 300 to 340 range. I would tell you I'd be a lot more excited about the stock if it got above its 50-day moving average, rotated above around 345, which would be the most recent swing highs. Really hasn't made a higher high yet. So by my measure, it's still classified as in a downtrend until proven otherwise. TripAdvisor, on the other hand, concerns me because it's in a topping pattern of sort. TripAdvisor looks a lot like the chart of Peloton right now, where it's, if you look at it, you see a high surrounded by 2 lower highs. Look at this, what's called a shooting star candle, or what else could we call this? I'm going deep in my candle memory here. A gravestone doji. You probably don't need to know that, but that's what that is. We have the open and close right about at the same level, and then a big long upper shadow. That's what that means. And it's as ominous as it sounds. A gravestone doji is sort of a negative pattern indicating distribution. And sure enough, that's kind of what's happened since then. The kicker with TripAdvisor is you really haven't gotten the downside confirmation of breaking down through the neckline. When you have this sort of pattern, you look for the interim lows, right? So you have the low here in March, a low here in late March, and then we've retested it. So when we broke the 50-day, that was certainly a check in the minus column. We have not broken that neckline, but I would tell you if we do, it measures a lot lower from here. If you're not familiar with what I just described, actually on my YouTube channel called Market Misbehavior, I actually just recorded a video yesterday on Peloton walking through a very similar pattern and why the neckline is so important. So check that out if you want more information on how to think of it. So, overall, the chart of TripAdvisor, a little more constructive because the RSI remains in the bullish range. Zoom, actually, the RSI has remained more in the bearish range. The RSI hasn't been above 60 in quite a while. Overall, it's in a pretty strong downtrend. The weekly chart shows you some differences as well, right? So both of these obviously coming off pretty good from lows. You can see both of them have rotated lower. That's where the sell-off in the sell-off in TripAdvisor, the sell-off in Zoom sort of look similar in terms of pulling back from the previous highs, but look at the differences leading up to there. Zoom is not far off of its IPO, right? It's about 2 years in from its IPO date, second quarter of 2019, whereas TripAdvisor is a little more established and really was in a downtrend before reverting higher, starting at those March lows. The weekly chart is what tells me to be more cautious, though. Look at the weekly MACD, which has just broken down. This is actually the weekly PPO, just generating a sell signal this week on TripAdvisor, and the PPO on Zoom still negative, but certainly more in a downtrend and looking more for a bullish signal, which has not quite happened. With all of that in mind, boy, if I had to pick one or the other, I would probably take a shot at Zoom, only because it's had a pretty good downtrend. It's starting to stabilize, and I'm seeing signs of turning higher on the weekly PPO. TripAdvisor concerns me because I think you're very close to generating potentially a pretty negative signal. This is just getting below its 50-day, and the challenge is, does it have much further to run? Both of those charts, I would argue, though, are not nearly as attractive as some of the other ones we've seen, which are starting to show real signs of accumulation here. So that is compare and contrast, looking at two different stocks, Zoom and TripAdvisor. If you're watching this on our YouTube channel, put a comment below. Let me know which of these two you'd vote on and why. I'd love to know. We need to wrap this show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number one is Netflix. Netflix, obviously, just coming off of their earnings report. It was not a good one, and Netflix was down about 10% in the after hours yesterday. Came up a bit from that, but still closing down about 7.4%, closing back below its 200-day moving average. It did that a couple times here in March, and the March low was pretty much a sell-off below its 200-day before we bounced higher. I'll be very curious to see if you get accumulation going through the end of this week, but I think the distribution is pretty concerning. Also, again, as we've talked about before, the chart of Netflix has gone nowhere since last July, so don't forget that. Chart number two is AT&T. This is reporting earnings before the open tomorrow. A little more constructive chart. I like the accumulation that you're seeing in here. It's an interesting one to compare and contrast with our first chart, because AT&T includes things like HBO Max and other parts of the AT&T media family. Finally, we have NASDAQ. It's worth noting, I love highlighting stocks that are making new all-time highs. And this week, NASDAQ again making new all-time highs, coming off of an overbought condition. So it tries to, makes me think about Frank Cappelleri's chart, looking at the S&P at the upper end of that channel. Charts like NASDAQ that overall, I think long-term are very nicely set up. In the short term, the concern is you're in that overbought region. You're just coming off of that. Does that mean we need a bit more of a tactical pullback? Do you wait to get a pullback to the 50-day? And I would say that's probably a place where I would start to look for some opportunity on a stock like this, making new all-time highs as things are a little bit rotational at the moment. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. As a reminder, you can get all of our previous episodes, including our fantastic guests, on StockCharts TV on demand. Go to StockChartsTV.com and check it out. Special thank you to Frank Cappelleri from Instinet, joining us today from New York, giving us his take on the S&P 500 as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.